Well, thank you, Simone. Nice comments. I gather there's not a pointer on here. Antoinette, I think, let's see if I can actually make this. Well, first of all, we got to get, well, there's the title, so we can start with that. As you can see from the title, the subject matter is dealing with the propagation and trying to measure and analyze the propagation of macrofinancial risk. Clearly, this is linked to such subjects as systemic risk, who's interested in that? Well, a good part of the discussion today has flowed in and out. Before I get further, I just have to say in the last talk, my first paper on portfolio theory in continuous time was published 44 years ago, okay? That was an abstraction from complex reality, because of course you didn't do continuous trading. But you could do pretty reasonably fast trading. 44 years later, we're hearing about a latency between trades of 1 to 2 milliseconds. So we're getting close, practice to theory. Anyway, back to the theme. For better or for worse, as Andre pointed out. Now, what I point out is, in addition to the official sector, financial stabilization, and so forth, interest in this, there's a great interest in this among asset managers, particularly large ones. Sovereign wealth funds, very large pension funds. You can certainly think of some individual private sector asset managers who have very large asset bases, where the idea of getting out of the harbor if you see the storm coming isn't feasible. And therefore, if you can't get out, you better be able to understand or measure and prepare yourself to deal with it. And so I would say this topic, although often thought to be related simply to financial stability in the official sector, is of broader interest, and it seems to be the way. Now, we know that in the crisis, while some people are calling it the two crises, especially if we're calling it, of 2008, 2009, that we could say later, I don't know whether we have an ending date yet on the euro bond market, but those two crises, we know at the center of that was credit. And so the focus for my discussion here and the examples I give you are going to come from the dimension of credit as a result of credit interactions or credit exposures, how those risks can propagate across the sectors and then across geopolitical borders. Now, in doing that, I am going to break my talk into three but not equal parts. First, I'm going to do some structural analysis to set up, the structure of what you're about to see. Many of you already know this, so I'm going to take advantage of having an MIT crowd that I can do the talk this part of the talk quickly. That's the fun of having MIT people. Then we're going to talk about, after saying the structure, how do you go about quantifying the measures of these risks? In particular, the question that comes up about connectivity or connectedness. When you have a bunch of institutions, we'll be using in particular banks and insurance companies. I'd love to have had pension funds, but unfortunately we didn't have the data, and sovereigns. And we're going to look at these and how they interact with one another with respect to credit, and how they're connected, and how their connectedness changes through time. Because as you'll see, the one thing you can be sure about is these connected amounts, quantities, and significance are not stable through time. They change significantly, and that's why it's important to monitor them. So we're going to tell you about how to measure that quantitatively. And then at the tail end, I want to use this to talk a little bit about the limitations, or the subtle limitations, in the official sector. By that I'm thinking of central banks primarily, in their macro modeling of what's going on and what's fundamentally missing from those models, which we believe here at MIT and in finance has a lot to add to. So you can think of this as dovetailing into macro at the end. So those are the three. Well, let's get started. Here's the structure. We got to talk about credit. Now, I know many of you know more about credit than I do, but a few of you may have your specialty somewhere else. So this is a 5-minute lesson on credit, okay? But for MIT grads, okay, finance grads. All right, so I have here in my hand a mortgage, bank loan, pure vanilla, nothing, not a big tranche thing or anything. All right? And if you'll forgive me, I'm going to be provincial and talk in dollars, not sterling or euros or whatever, because I'll always get it screwed up. So here you have this mortgage or bank loan in dollars, US dollars, and we now staple to that a full faith and credit guarantee of the US government of this piece of paper. Okay? Up here, you can see this is, I put it a corporation. If you'd like, following Antoinette, dealing with the household, you could rename corporation, household, operating asset you could call the house, debt you could call mortgage, etc. But let's call this a corporation. And let's think of this thing that's stapled here is the thing that's fully faith guaranteed. Functionally, what did we have in my hand? Risk-free debt. It's a virtually perfect substitute for U.S. full faith and credit. Doesn't have the tax features, doesn't have the collateral features, but it's risk-free, certainly as much as any treasuries. Agree? Now, unfortunately, we're going to rip off the guarantee and we're back to what we started with. So if the two together is risk-free debt, what must be this by itself? It's risk-free debt minus a guarantee. That's just logic. Now, what is the guarantee? In this simple example here, we think of this as, let's say, zero coupon, so I don't have to go through all this. There's some date when this is going to come due, and there's a principal amount to be paid, and you don't mind if I use a symbol like B for the amount that's owed, for like $1 billion, if that's, that gets your attention. In any case, personally, I mean, of course. If this is $1 billion, what's going to happen when this debt comes due? Well, in one possibility is you get paid. And if you get paid, you go off with your $1 billion. What was the guarantee worth in that circumstance had you had it? Nothing. It's insurance, and you didn't need it. So that's pretty clear, so it wasn't too bad. But of course, we all know there's another possibility. That we get to the date, we come for our $1 billion, and the firm says, sorry, we can't pay you. There isn't enough market value in the whole left side of the balance sheet to do it, so whether we want to or not, you're not getting it. Now, we all know that's a period of things get messy, and I don't want to go through that, but in every kind of debt contract, what's the fundamental rule? In one way or another, whether you have to go through the courts or whatever, at the end of the day, you don't pay, then the assets that have been pledged against that loan go to the lender. So what do I get from my piece of paper, abstracting from all the costs? I get the value of the assets, market value, which I call V, all right? Now, you know V is less than B, right? They're not going to pay you more than they owe you because they can always get the money, so you know that's less. So in that case, what's the value of the guarantee? Well, with the guarantee, I get my $1 billion. Without it, I would have gotten the market value. So the difference in that case is $1 billion minus the value of the assets, the recovery. I just wrote that succinctly as that payoff is the maximum of 0 and B minus V. Now, I hope all of you, even the ones from 40 years ago in the 70s who got your degree at Sloan, if you went through finance, 412, 415, you name it, below 422, I hope you can remember what this is even if you haven't used it in a while. What's that payoff? Please, someone? I saw your lips. It's a put option, yes. It's a put option with a strike price of $1 billion, and it's a put option on what? The assets of the borrower, the corporate assets or the house, or whatever the collateral is. Why I take you through this is not to say this, and again, many of you know this already, but I want to make sure everybody's on the same page. It didn't take that long, okay? Is because you know a lot about options. You've lived with them for 40 years, you've traded them, some of you, they're everywhere around, they're ubiquitous. So you suddenly, if you didn't know anything about credit, know a lot more about credit, pretty quickly. Like you know the effect of the assets that are the collateral become more volatile. What's your prediction on the value of the guarantee? It's going to go up. So you know all that. That's just a shorthand to make you experts quickly. All right, if you weren't already. So we see it's the same as a put option, so we're going to leverage that knowledge to move forward. By the way, at least at the level that we would use it here, you also now know what a credit default swap is. It's just the same insurance, a little more complicated terms or different terms, but that's a detail. So you now know how to deal with the CDS if you didn't. All right, so everybody on, so far so good, right? So now I want to show you another picture, and I want to point out a feature here that when you take a bank loan, mortgage, or whatever, the real action is, it's made up of, you told me, a risk-free asset minus a guarantee, which is a risk-free asset minus a put. So the first thing to recognize is if you're buying bonds or loans, you're actually in two businesses. You're lending money risk-free, which is classic time value of money. We all know that. Okay. But you're also writing put options, which means you're writing insurance, which is a very old and honorable activity in finance. But you better darn well know that you're in the business, because they're very different. And for those who are not there, lending by tradition, when you talk about the lingo, spreads and so forth, don't delineate the two. Obviously, people in the business understand that, but if you're just looking at it, it can be very confusing. Or at worst, it looks more simple than it is. All right, that's the real big problem. So let's focus on the put. So a bank makes a loan. We know the value of the guarantee that the bank has, right? The bank has actually written a guarantee. It's written a put, right? It's written insurance. That's its picture. That's generic. And we see from the picture that if the assets at the time of the loan were AC, that's the value of the guarantee. You subtract that, and there's the price of the bond. What happens if the assets fall? Well, you can see from the picture in common sense, the value of the guarantee goes up. It's a put. The value of the debt goes down. Well, actually, you're already ahead of the game with respect to many people when you look at the way they mark a loan book. They don't change it unless something happens other than that. But what do you see from the picture that most all of you already know? What's going to be the risk of this for the next roll? We know what happened. It moved from AC to AC prime. We know the value that went down. So let's say we recognize that the asset became worth less. But what else has happened? Do you see that slope? Before, when we moved from AC, a move in the assets had the slope of the flatter slope. So let's say it was minus 5 cents for each dollar move at AC. When you get to AC prime and you roll the dice again, what happens? Bigger move. And that's, of course, the insidious part about credit. You can sit with the bond. You have no defaults. They're all performing. The last interest check came in. But if the asset falls, two things happen. Your asset goes down in value, which if you do nothing else means your capital base is falling. But not only that, your risk is going up by more than the capital fall because it's a steeper slope per unit. You see? So that's a fast pass. Now, if you don't mark that, you can see that's a good way to get into a lot of trouble, and how you can have things that cumulatively can get from relatively low risk to very steep risk, right? And then when you discover it, you say, oh my God, this was a 10 sigma event. Well, it wasn't a 10 sigma event. It was 10 sigma on the slope down here. But on that slope, it was 2, because the slope has increased so dramatically. So this is a fast pass. It also gives you a hint. This has some relevance for understanding at least part of what happened in the crisis of what we observed. But that's not my purpose here. So everybody on board, the value of the guarantee is a put option. Okay? And it has certain risk properties. Now, let's talk about the guarantees. Now, it's pretty easy. Simon and I are, Simon being both in every way dominating me. He's guaranteeing my debt. He's the government. Governments do that, right? As banks, they do it both explicitly, we know, with deposit insurance, but they also do it implicitly, as we've also seen. Okay? He's guaranteed my debt, so he's written a put option on my assets. Probably not wise, but he did it. But suppose I then turn around and guaranteed Saman. Now, Saman being Saman, he's a, AAA, we don't have to worry. But let's say he weren't quite AAA, or let's say he wasn't perhaps not quite single A, okay? Then what's going to happen here if you have one entity guaranteeing the other with a cross guarantee? I get into some trouble, right? Exogenously, housing price drops for some reason, corporate assets drop for some reason, okay? Now what happens? We saw the picture, the previous picture, right? His liability goes up, his capital goes down, and his risk goes up. He's weaker than he was before I got into trouble. Whoops. If we put the picture, but I've guaranteed him. He's gotten weaker, which means what? My guarantee of him is also going up. And since I'm short, I've written it, I become weaker. Well, of course, you see where this is going. Now he becomes weak, and this is called feedback. All right? Now someone might say, what idiot would ever enter into that kind of contract? I have a short list here, okay? But, what can he say? You can see, this has some relevance to Euroland. Why? Because what's very typical of sovereigns in many, many places, including in the case of Euroland, sovereigns often encourage, or at least very happy, when their banks buy their bonds. Especially when the sovereign's having a little difficulty and likes to have someone holding their bonds or buying their bonds. Well, what do we know from the analysis structure? Every time you buy a bond, you're writing a put option or a guarantee for whoever issued it. So do you see what happens? We all understand that the governments, the sovereigns, guarantee the banks. But by the banks holding the sovereign debt, they're actually guaranteeing their government. That is a fundamental feedback mechanism. Okay? And that's a part of what's happening, except it's a little more complicated when you look at Euroland, because I made it simple. Sovereign, the sovereign's bank. Spanish government, Spanish banks. But of course, what really happened was, you had the sovereign to the bank, the upper one, let's call it Spain, the lower one we could call Germany or Greece, you pick it. But what else is happening? Say if it's Germany, German banks are holding Italian debt, so they're guaranteeing the Italians, and vice versa. And then the banks are playing with each other, and you start to feed all of that around. You see that leads to a lot of complexity in reality, even from this level of structure. Remember, just this simple one. And that's why it's not so simple to say in solving the debt, let each sovereign take care of its bank and let's go, because there's all of these cross effects that are having these feedbacks going up and down. Now, this is the tip of the iceberg. I'm not going to spend any more time on it, but I wanted to give you some structure because you're going to see some numbers and pictures, pretty pictures. I hope you like the pictures, okay? But if you didn't have this as background, you say, hey, this guy's run 14,000 regressions, or at least he has 28,000 coefficients, and he's trying to tell us about them. You say, what? This is what we're looking at. This is credit. And what we're going to do is we do a very simple statistical. First of all, we compute something called expected loss ratio. I hate it. I hate it almost as much as the term contingent claims analysis, CCA for those who took the course. But like many names, once it's established, you can't get out of it. All this is you take the value of the put, the value of the guarantee, divided by the value of the bond if it was risk-free. So it's like a number like 3% or 6%, like a CDS. What it's really saying is, what's the cost or the value of guaranteeing this bond based on the bond being risk-free value? In other words, when you take its risk-free value. So it'll be a number like 6%. Do you understand? So this ratio is a measure of how much credit costs to guarantee. The higher that number, the worse credit. If you have a perfect credit, it's 0. All right, so we compute that number. We now have a measure of the credit ratio or the expected loss ratio for sovereigns, banks, insurance companies, and everybody else. And we ask the question, very simply, in a regression you'll see, we take entity J, K, and we say J, and we say, We look at the credit of entity J, which could be a bank. It could be Sloan. We didn't have the data, all right, at time t minus 1, and relate it to the credit of some other entity K 1 month later. You could do it anytime, tomorrow, but 1 month later. So everybody understand what that regression is doing? So it looks at the credit value, what it costs to insure an entity J, and then look at entity K, what it costs to insure it a month later, and then ask, what's the relation with them? A simple regression. So that's the regression coefficient. Thanks to Simon, he's seen this before. He corrected, as usual, he corrected that I had the coefficients backwards, but I think they're okay, right? BKJ is the measure of that. But we can also ask the reverse question. If we look at entity K and ask ourselves, look at its credit, and then look at the credit of entity J a month later and say, what's that? And that's BJK. So you can look at one into the other or switch them and say that to this. So the bank to the sovereign, but then we also could look at the sovereign to the bank. Okay? Now, what we say is, if the coefficient BKJ is significant, then we say, and this is a technical term, and we have to be careful about this, especially at MIT. We say that if it's significant, then we say J influences K. I almost wrote the word J causes K. And in fact, the Granger causality test, which you're going to see in a moment, has that word in it. We all understand this is not a structural equation. We can't attribute causality. It's a reduced form at best. Okay? So I will use the term just descriptively as causing, meaning something that happened last month related to something that happens this month. So do you understand? Okay, enough on that, but just to be sure. And then we can ask if we say that, and then if we run the other one and it's significant, we say K influences J. And if they're both significant, what do we interpret that as saying? Each influences the other. That's tentatively like what would happen in that feedback, right? Bang, 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 bang. And we call that mutual influence or feedback. So everybody understands. So we take all the banks, all the insurance companies, all the sovereigns, we compute this number. Now let me tell you where we got the estimate of the put option, the cost. The natural place that everyone would say is, take CDS. Aren't we lucky we have that market? Because, no model is good as market prices. At least, well, I know there's some who disagree with that, but most of us believe that market prices are a better indicator, more reliable. At least that's what you would pay for it. Okay? We used CDS to measure the credit of the sovereigns, partly because it's difficult to measure sovereign credit. Okay? But we did not use CDS for the institutions, particularly the banks and also the insurance companies. And why not? Well, yes. You have a question?
It was built into feedback. If you use CDS price on the bank, that includes the price of the bailout, or the probability of that. So you would be taking away the very thing that.
You're right, in the sense that we want the total credit risk of the institution. That's what we're trying to measure. Who takes that risk is a separate question. But we know that governments take the risk of banks. Think of the extreme. You get a full, and we've seen a few of those, so maybe we can't call it an extreme. Take a terrible credit institution and have the Fed or the Treasury or somebody put a full faith and credit guarantee on it. For the time that that guarantee is on, what's the CDS going to sell for? It should be zero, but it'll be whatever Treasury U.S. CDS sells for, right? Because you don't care. Just the same way we don't care when we have a deposit in a bank, whether that bank's crummy or not, as long as it's insured by the depositor. So CDS is really going to be measuring, in that case, the private sector risk component. But we want it all. So to get it all, what we did is actually revert back to pre-CDS and use a model that sometimes, for good or for ill, has a name on it, the so-called Merton bond model from a zillion years ago, which is, to estimate this put-up, to estimate this guarantee, all right? Well, we did a little better than in, the simple version. We use the so-called KMV Moody's stuff that came out of the same technology. And the idea is to use something that has been used in the marketplace for a long time. So we're reasonably confident these are not silly numbers, even though they're not market numbers, okay? And that's what we use for them. So everybody understand now the data? So we have credit measure from those two ways, and now we're going to let it go. So we run all of these, and we get all these coefficients. You know, we had 60, well, let's see, I'll show you what we had. Whoops, I must have missed the, yeah. I don't know whether, I guess I didn't list the data yet. Well, whoops, yeah, I didn't list the data yet. Oh, well, I'll say this now. This is in case I'm anticipating a question. Why did you do a simple regression between these two and just look at the significant coefficient? The answer is it seemed like the best first step. The other is we could interpret it. You know, we said, is this a significant coefficient, and it's just a 1. If you want, we can do a complete, you know, multi-vector distributed Granger causality backward and forward of all the institutions with each other. It's a nightmare, but we can do it. So the principle is the same. We're just showing, by the way, this is research in progress, but enough progress that one of the co-authors, and we're several of us, that are listed, but they're not, that I'm pretty confident that even if the numbers change, that the methodology is in the right direction. So that's why we're showing it to you. But this is definitely work in progress. So we can do all of this stuff more generally. But here's what we did. We got data on 17 sovereigns, 63 banks, 39. We use this DM, we compute all these numbers. We run all the regressions, and we only take the significant ones. So we take only significant coefficients from whenever we run it. Throw everything out. So everything you see, all the pictures you see, only involve where we found statistically significant relations. And then we looked at all the comparisons. Well, you can see, you know, there's, if you take 63 and 39 is 102 institutions. If you ask 17 times that for each sovereign, you're already up to what, 1,734. If you then take all the other ones, anyway, you could, if you took all the combinations of everything both ways, get up to 28,000 coefficients. I could have put this up on the screen for the rest of my time, just rolled it. And I know there's at least 2 of you out there who would say, yes, I see. But for the most of us, a C of 28,000 coefficients, if significant or not, or whatever number are significant, doesn't work. So what we did is try to find a picture, a way of showing you. We use kind of a network type theory, you know, network stuff that you probably see. How do we make a picture, you know, 1,000 words in one shot? So here's my first picture. The blues are insurance companies, the reds are banks, and the blacks along over here are sovereigns. And in there, those black lines are sovereigns going to things. The blue lines are insurance companies connected at one end or the other. And the red lines are banks. Purposely, even with great eyesight, I don't think you could see everything here. I want you to see the mass. Don't look too detailed. But if you could see the detail, which you will shortly, you will find that several things are done in this picture. First, only lines where there was significance are drawn. So it's not every possible line, otherwise you just have a solid mass. Secondly, we used eigenfunctions, or think of it as principal components, to ask who are the most significant kind of entities, because you have all these different connections, right? Who are sort of key players for a lot of this? Which banks, which sovereigns, do you understand what I'm saying? And we located ones that were stronger with each other, physically closer in the picture, so you get densities, right? And the ones that, you know, and closer together and with stronger significance. So we're trying to build in, if I were Ed Tufte, you probably, not all of you know who he is, but he was a kind of almost close to a genius over the last 30 years in putting the maximum amount of data or information into one graph or one picture. And, you know, there's some very famous ones that he did. We're trying our hand at this. How do we convey to you a lot of information in one place? So we do a lot of locations. There are arrows at the end of each of those. Remember J causing K, K causing... So there's an arrow if J causes K. If it's K causes J, the arrow goes the other way. And if it's both, there's arrows in each direction. So as you look at them and blow up the table, you see what's happening. Okay? Now, this was for the period prior to what most would call the crisis, up through June 2007. That's the picture. Everybody see the picture? Now we're going to do the same thing for after we get into the crisis up to 2012. So before crisis, after. Everybody watch, take a close eye, take a picture in your mind. Now, before we talk about it, do you see any difference? Okay? So before you think about anything, what are you getting a message? First, that something's changed. But what's pretty clear is there's a lot more significance, and if you looked at it carefully, in many cases, a lot stronger connectedness, okay? And you can get a sense from the shadings, even before you get into detail. This is the most important two pictures, it's the prettiest ones, because what this tells you is the following. If you accept that this is a measure, it's not a perfect measure, but, and mind you, this is only measuring connectiveness with respect to credit. If you had a bank and another bank that did tons of business with each other, a lot of flow trading and everything else, it wouldn't necessarily show up here at all as connected. So don't think of this as a measure of institution connectiveness broadly. It's only their connectiveness as it's related to the association between their credits, their credit. And so that's the way to interpret what you see up here. And when you look at this, this is telling you that there's been a change, and what's, you know, and perhaps we ought to look a little closer. So we took a couple snapshots. Connectedness of Greece. That's Greece, one of the blacks. Okay? And you can see in 2008, you know, there's a lot of connection, a lot of blacks in there. If you could read the reason in blue. We're not going to go through, maybe one case I'll give an individual name. But in most cases, you know, you just get a sense of how you would read this blown up. If you have really good eyes, you can see there are many more lines coming in across, and you see that there are different distances from one another. And sometimes you have blacks close to each other, and sometimes you have blues and reds. So all of that's going on. And this will change at different points in time. Okay? And if you could really look here, there's actually arrowheads coming in here. So you could actually see the direction. So you get an idea of that. You know, this is like a Google Maps. It shows you the United States, and you just keep going down onto what part of the picture you want. So that's on 208. Now, here's December 2011. This, you may recall, you know, things weren't great, but Spain hadn't really gotten into full attention, if you know. Remember, it was 2012 when they said I had that. Here's Spain, but you can see it's already, you know, there's somebody's out there. Who's over here? Italy. Okay? I'm going through this because I don't want to waste, you know, just let you get a feel for it. Here's 2012 March. Now, you know you have to be really careful interpreting reduced form multiple regressions to put too much reading of the cause, how to interpret it. And so I'm going to play with you this, not because I'm claiming that this is, we're actually saying this is what was going on or why, but to just show you how you might think of this. What is this telling us? At the top, there's the U.S., the United States, credit. What does the picture tell you? Not very connected. The U.S. was not a player. How could that be? It's the biggest thing. The Fed wasn't a player. Well, remember, this is about credit. How does it become a player with credit? Well, at least directly, it does so either because its credit's being impacted or it's impacting someone else's credit. Think of the time. You remember March 2012? I'll remind you that was an election year in the United States for president. Do you think that the U.S. was going to be really hot to write a big check to Europe or European banks in 2012 before the election? You know, you make that judgment, but so they're probably not going to be a big player in sense of doing something which is going to impact this credit from there. Were people in the world really worried about the U.S. defaulting as a sovereign in 2012? I don't think so, but you could disagree. If you buy that, that could be what this is kind of saying. It's saying at that point in time, the biggest player in the world wasn't all that connected to what was going on. By the way, you'd find similar things at that time for the UK, less surprisingly for Sweden and Switzerland, okay? But I'm just saying there, here's Italy on the other hand. Right in there, as you could expect it might have been. All right, so do you get the sense of how you could start to think about using this and how the charts are changing? And here's a blow-up of the same date, and there's Italy. Now you start to see all those lines, and you start to see the thicker lines, bigger numbers, closer together, arrows. I don't know if it may be unfair to do this to you. If you can't, pretend you can, that you can see the arrowheads, all right? So let's look at all of that. Now, if you'll notice, here's Spain, that's Italy. I feel like I'm in a planetarium, you know, showing, yes, sir? You have a question? Oh. Yes, can you see that? That's a red, so it's a bank. And you have good eyes. If you can, the back, I assume you can't read that, right? If you can, you're scary. It says USA GS. GS is a bank. Do you see it's kind of connected at the hip here with Spain? I don't know why, but I pointed out. And it's, you know, kind of all surrounded by these other sovereigns. So although U.S. sovereign, I showed you before, is up there, Goldman Sachs, for whatever reason, is there. Now, this is not bad, it's not good. The thick change in picture I showed you to begin with, that was telling you, at least based on this measure, that connectedness has gone way up. That's not inherently bad. You understand? We're not saying, oh my God. But what it may be suggesting is much greater vulnerability through a much higher degree of connectedness. This is the kind of thing that people talk about all the time. And what we're trying to say here is, to the extent that you bought into what we're doing in terms of the methodology, this is giving you a picture, a map, a heat map, if you like, of these, could be pretty complicated connectivity, and that it changes through time. And I'm going to show you some more quickly now. So you got the micro. I'm not going to belabor it anymore. The only thing I would say is, we view this at the moment as not answering questions. We think the real power of this at the moment is asking good questions. You know, it's like problem finding versus problem solving. What I mean by that is, let's just, since we mentioned Goldman, we see this in the picture. The question becomes, why? Why is Goldman so close to Spain? Why is all this there, if we have any interpretation? That might be a good question to ask if you're interested in what's happening to Goldman Sachs. Now, when you investigate it with your other information, you may say, no problem, I understand why. But do you see what I mean by it's asking a good question? It's raising questions, and when you see all the connection, it's raising lots of questions by looking at the picture, for which you could then say, let's investigate and see what the potential answers or implications are. So we're not saying this is a solution. We're not saying, don't interpret this as saying there's something wrong with Goldman Sachs or anything else. It's just saying these seem to be very highly connected with these set of entities. Why? Okay? I already told you it's not causal. So for example, if you saw a high degree of concentration in your central banks, I put them collectively, even if everything is right here, there's no implication that by them taking actions they can change it. That's only true if it's structural. They probably can, but you understand the difference between a structural equation where you know if you change one variable, you change the outcome, and a reduced form where you get perfectly good prediction, but you can't change behavior. You see the difference? And we certainly are nowhere near the stage of saying this could be used by entities for good or for ill to try to, in some way, modify policies to avoid. But at the very least, even if you can't modify the policies enough to affect it, it's a forewarning of something to be looking at. We heard several times, last night there was some discussion I had at dinner, and a few of the times today, people saying, it's amazing nobody noticed what was coming in 2007. Some people did, but nobody was picking up. This is the kind of thing we would hope would give a heat map and give changes, especially when it changes. So everybody on board? All right, let me move on. Who's the timekeepers? You someone? Oh, okay. But you'll tell me when I'm not. Yeah, okay. He's got a big hook. All right. That's the one advantage of being the last of the day. There's a disadvantage, the obvious, but the one is that there's no one to crowd out. And anyway, so let's go and show you some other things we did, more dynamics. What we did here is we said, let's look at the sovereigns. And remember, arrows out from the sovereigns to someone else means the sovereign, in some sense, is causing an impact on the bank. Sovereign gets weak, the bank's holding the sovereign's bonds, it impacts the bank. The bank gets haircutted, even though it's a very good bank, because its sovereign comes down. I won't mention examples, okay? But what else could be happening? Ireland guaranteed all its bank. I will mention that. Does anybody recall what happened at CDS when that happened? What happened to CDS of the banks? Way down, right? What happened to CDS of Ireland? So you just had, the banks were very expensive, Ireland guaranteed, okay? I think that case you could probably say that the banks were, that the action of the government created, that was flowed from the bank's credit condition and the government. You see, it was going that way. So what we did is, the blue is from sovereign. You should interpret the blue line as saying, how many connections, what percentage of connections? You should read that as a percentage of all the possible connections. So if there's 1,734 possible connections, just as an example, and there are 867 connections, then you'll be at 0.5. Half of the possible connections are significant. That's the way to read the y-axis, okay? The blue line is the number of significant connections from sovereigns to institutions. That's where the sovereign is impacting, whatever's happening to the sovereign is impacting the banks, okay? And the red one is from banks or insurance companies to sovereigns. Now, what you can see here is prior to the crisis, we had very little impact of the sovereigns on the banks from the sovereigns. See, the blues are very low. The reds are up there. And that happens until we get into 208, 289. You see the blues went up quite a bit. That's the region where it started to happen that the sovereigns were impacting their banks, the banks, because of their own credit problem. So in kind of pre-crisis, what you kind of expect is sovereigns aren't being affected by their banks too much, but that's the way it goes. And the same thing with the red ones. So I'm not going to go interpret every one of these for you, especially at this hour, and we have cocktails ahead of us. But what I wanted you to see is how you can build a time series of this and find various ways to show how the connectiveness is changing and the causality, at least the way we measure it, is changing as a dynamic. And we think this is encapsulating some interesting information as a way of encapsulating in a way that you could look at it. Now we did one more, same pattern. The red is banks to sovereigns, purple sovereigns to bank, and then we did sovereign to sovereign, which is the blue, little light blue dots. That's where one government and another government. I think you can see that from the pattern there. That's, again, not surprising when we get into the height of things where it was happening. Okay, so you see how that you get still another. Now, this one, there are 5 countries that got special attention in this crisis, as you well know. And there was an acronym for them, which my co-authors and I decided was a kind of a pejorative acronym. So we searched around for one. The best we could come up with was GIIPS, which isn't great because if you say it really fast, but it's not as bad as the usual acronym. And this is looking at Greece, Ireland, Italy, Portugal, and Spain, and asking what happened in the connectiveness of those 5, where what we measured is from them, that's when those 5 countries are impacting others. So you would say our credit going up and down impacts the rest of the world versus, and then we subtracted the ones where it was the arrows were coming into that. Now, what you see here is, since we're taking the difference, you see here back in 05, it's minus, or you may not see the number, it's like minus 80. what that's telling you is, if you interpret it, that almost all the connectedness with these 5 countries was coming from elsewhere impacting them. Now, you could argue that's not, that's kind of normal. Greece is a small economy, Ireland's a small economy, and so therefore the way you would think it would be going is that they were being bounced around about by the rest of the world. But look what happens as you come into 08, July 08, September, all the way up there. It goes screaming way up, and then it comes way down again. Well, you have to ask, why are you getting these effects? I'm not going to read the tea leaves anymore. I did enough of that to try to get you to think how you might think about it. But I think you'll find if you start to map these up, that there were feedbacks. At one point when they got into, one or more, Greece or something became is going one way, and really changed. You see, that's what I wanted you to see. It went from being quite, they became quite more, in some sense, the causalities. Their credit got whacked, it gave feedback to others. Then it went the other way. It was back. You say, how did that happen? Well, think it through. What was going on? The first shock was, of course, Greece hitting everybody else. But what happened after everybody else started to react to it, and we saw what the reaction was, and people were going to start writing checks or not writing checks? That could feed right back to them. So every time you thought those 5 were not going to get helped, you could see that announcement. The credit goes up, and it can go. Do you understand what I don't want to. I'm trying to give you a feel for this. Don't. This is not science. The technique is what we're trying to do is. That's what I really wanted to show you. But I'm trying to make it meaningful in the sense of why you might be interested in this. Okay? And then, all right. So that completes the second part of my objective. And now I'm going to finish up by looking at the official sector and looking at government policies and what the implications of this kind of thing are and what we need and what we don't have. So you saw how you could use this heat map to work out all the credit things and so forth. This is a schematic done by Dale Gray, one of my co-authors, and multiple times we've co-authored, and he's a co-author on this along with Andrew Lowe and others. We looked at governments kind of do 3 things that we think about. They do monetary policy, they do fiscal policy, and they do stability. The general practice is that those look like they're kind of done in silos. Sure, they talk to each other, but they're not integrated. Or at least as far as I know, they're not integrated. They talk to each other, but they don't do a kind of a general, let's coordinate all the activities. And so, as you can see here, if monetary policy brings long rates down to practically nothing for a long time, one of the implications of that for institutions is that the whole pension funds are put underwater, big time. Some could argue, since they're 30% of the assets under management in the world, that that's something that could be systemic that you might be thinking about, okay? Just as an aside, the real estimate of the underfunding, that is the amount that we would have to write a check for the public pensions alone in the United States, not Social Security, not corporate, but the teachers, the states and locals, is $4 trillion. A lot of that is the result of interest rates coming way down and liabilities going way up. The same liabilities, no difference in cash flow, but huge thing in the value of what it takes to fund that cash flow. Don't you think that if you're going to have a monetary policy that you ought to be considering the implications for stability? That's what we're saying here. So this is a map of how you could use this structure to integrate it. The second thing which I want to point out to you is the models that are used in, as far as I know, in the best or biggest central banks are macro models. They are, some of them are nonlinear and so forth, but they are fundamentally certainty models. They're models that are built as if the world was certain. They do not have in them the uncertainty structure. Well, what do I mean by that? Just what I've been talking to you about. Remember I taught you about credit? Did you see that put option? That's insurance. In a certainty model, what's the value of insurance? 0, because you know what's going to happen. Is there any convexity in a certainty model? No. Is convexity and all those things you saw in these pictures maybe kind of important for how risk propagates from from the households to the banking to the government back to, okay? That's what I'm talking about. They are absent from the central bank models because they are built on a philosophy or a modeling structure which is inherently certainty model. They put uncertainty in by adding an error term and running Monte Carlo simulations. But all of you here can understand the subtlety of the difference. If the structure doesn't include the uncertainty, doesn't include the optionality, the nonlinearity, the rapid changes in sensitivity, the fact that things shift with volatility even if values don't, all the things that we live and breathe every day. If those aren't in there, then on each path of that Monte Carlo simulation, when you draw the drawing, the model treats as if the world's certain, and therefore none of that's there. We think that's a very big structural hole, and we think the crisis is a pretty good case study. And what we're saying is, this is not a criticism of macro. It's saying it's incomplete. Finance, and of course that's who we are here, even those who are not are here because you're curious, okay? Finance is all about uncertainty. It's all about risk. It's all about building that into structure. So what we're bringing is our knowledge base, empirical experience, and real-world experience, because our stuff has been used by all of you in the real world for decades. So we're bringing market-proven technologies in and saying, how about putting that in with your models? So I wanted to locate this for you in terms of understanding the role that finance can offer or play in this whole area. And you can see, remember, we had a talk earlier about the Center for Finance and Policy. You can see where this might not be too bad stuff to be having in a place like that. And it belongs in a place in finance, not in a macroeconomics place, because that's not their mindset. We don't claim we have all the answer. We think we have a pretty big piece that when you bring it together, we can move the needle on what's there. Now, I have another picture. Remember the two bright colors? This is the picture of you did it right, integrating it. This is the models that are currently being used by the New York Fed and ECB. Although I should say, ECB for sure, I believe New York Fed, are looking at this first models right now as we speak. So I don't mean to suggest that they aren't aware of this and they aren't curious themselves. This is a case where I think practice is running ahead of academia. You won't find it in the macroeconomics literature, but you will find that central banks and ministries of finance and supranationals are looking at this stuff a lot today. So, but I wanted you to see the difference? That's what we should have and know how to do. So this isn't like cold fusion. Let's hope we can figure out a way. It's not easy to do, but it's an engineering problem in the sense that we know it can be done. And we kind of know how it can be done. And that's what I wanted to get across to you. So see that? Looks like a plucked chicken to me. But anyway, thank you so much for your attention at this late hour in the day. I'm sure there are, I'll take questions, but if not, that's fine. We can go for drinks. I'll be around if you want to talk. Thank you.
Is it on? Yeah. Walker Sigismund from Sloan School in '87. You have given a very interesting talk today. I wanted to sort of give a little bit, not so much a question to you, but more of a comment. So one of the things I did learn at the Sloan School was very much about your theory and the Merton model. After leaving the Sloan School, I worked first in Wall Street and then in the industry here in the city, measuring the risk for large corporations, and started actually using these techniques within the firms to measure their risk. But in 2006, I joined the regulator here in the UK, and immediately started applying these techniques that you're talking about, that is the Merton model, to the entire portfolio of K&V firms. I have all 50,000 of them. And on a daily basis, I've been marking to market using these techniques, every bank, throughout the crisis, and using that information to actually predict from 2007 on who was bearing that risk and where it was located and who was next to go down. I've run in, though, to very much the problem you're talking about at the end. Central banks, regulators are basically run by economists. They don't get this optionality. And so there's a huge problem there in actually selling these ideas and in a sense, taking over that, well, getting into that space where they actually listen. Because literally throughout the crisis, in January 2008, I could name how much, say, capital each one of the UK banks would need, including RBS, Barclays, and so on, how much Goldman Sachs would need. In the US, I measured all the banks across the world. I was told by the regulators and the senior management that wasn't a problem. They just visited those banks and they thought they were okay. In the summer of 2008, so 3 or 4 months before Barclays went down and RBS went down, I said, you know what, these banks are right on the cusp now. It's going to happen any day. Again, I was told, no, it's not a problem. We've just been in and visited with them and it looks okay. There's not going to be a trigger mechanism. So basically these techniques do work. I've been using them day in and day out to measure the financial crisis throughout the financial crisis, and it's exactly this sort of thing that we need here in MIT and elsewhere to make greater headway. It's very hard, but it does work.
Well, thank you. By the way, can I ask you a question to answer for the audience? Did you and I speak before this? Recently. I don't mean ever.
No, we didn't.
Okay.
The last time I think we probably ran into each other was at Palladium, where you worked and I worked. And,
Yeah. Okay.
So that was
I just didn't want you to think I planted him over
Well,
here.
There
I
could
just
be,
happened to do this.
There could be one connection, though. One of your co-authors has seen one of my talks and is very excited about it. So,
Okay.
there could be a bit of leakage through the back door.
But you understand. And I think, though, this is another reason why, Andrew Lowe and I in particular have been formally involved in a group which mixed with the so-called the top macroeconomists in academia and finance people to try to put the two together. I won't give you a update report on it, but let's just say I think it's always wise to use multiple channels, when you're not sure which ones are going to work the best. And so what we think is probably the wisest thing, as was done with finance in the 1970s, different story, different sector, similar times, right? Those of you who knew about it, all right, is that we in finance, we have the technology, we believe this is a good way to go. It's not perfect, nothing is. We have to do it ourselves. And then, of course, if you have transparency, if you have a center, I'm plugging the center, but MIT is a pretty visible place around the world. And if we can establish ourselves, a center that's putting out this sort of thing, not to say what policy should be, but giving you the information and make the world see what you reported. You didn't tell them what they should do, you just told them what you saw, and maybe they want to think about it. You see? And that's kind of the spirit. If you can get high quality, unbiased, but seriously done work, providing that kind of information, not saying you should turn down the banks, you should raise capital ratio. That's a policy decision, of which is not necessarily our expertise. But I think you're exemplifying, I'm taking more of your time, what we're really trying to do in the finance group when we talked about trying to do something for the world in this direction. That's a comparative advantage of MIT. This stuff was invented there. Fisher Black, University of Chicago, great school, claimed Fisher Black and Myron Scholes because they went there. They went there after they did the work, and they both did the work at MIT and Cambridge. So if there's anyone doubts the lineage, we have the DNA and the proof that it was MIT all the way through. So this is a tradition. It's not a new tradition. It's one that goes back all this time. And I think this is both at times frustrating when you can't get the attention, which we are, but it's enormously exciting about our field. And all of those of you who are engaged in the asset markets and related, whether you're analysts, whether you're hedge funds or anything, we think this kind of thing is going to be useful for you, not just the official sector, to get a sense of develop your kind of markets. Last thing is two very large firms, that were, one of them was on the slide that you noticed. Senior people there saw this. They talked about it. They thought it was a great thing to do. Now, that doesn't mean it's a great thing to do. But what you can always remember is you don't have to use the Merton model for the credit. You can use your own proprietary models. They're far better. You see what I mean? This is a template. It's like plug and play. Once you understand the tool and how to use it and how to analyze it, you can put the very best models in the world into it and do even better. So MIT is not claiming it's going to build the best option pricing model or credit pricing model, and that's what makes this run. What makes this run is all of what you've just seen and the continued attention to doing this. So again, I thank you. Any other questions? I guess you really, yes, all right.
There's one point here. This is really only useful, not only useful, but it's going to be very useful when you get into predictive model, and the predictive model can determine literally or determine your leverage points within the system, that where you're going to get factors where you can create those safety valves that if there's too much stress in the system, you can sort of tap into that safety valve and unwind it. Do you think your model is going to be able to get to that point, or it doesn't have that predictive nature?
Predictability, that's a good, everybody here predictability. As you know, one of the virtues of the whole derivatives model that we built over the years is it didn't need to know the first moment. You don't have to know expected returns to either estimate the risk or understand the valuation of all these derivatives, right? I mean, that's the first quiz you get from Simon when you wanted to go to work for him. He'd ask someone some question to see whether they understood that. If they didn't get the job for sure. That was it, okay? So finance people as a group, not practitioners, are not big into forecasting, in that sense, predicting. Well, what this map can be used, in the same way as the derivatives model can, is to express to you changes in risk and vulnerability. Doesn't mean it's going to happen. It expresses a vulnerability that could happen. And I just want to distinguish that, because we may be able to build predictive models. Macroeconomists try to do it all the time. There are some in finance who question how accurately you can forecast first moments in speculative markets and these things. But you can use this, for example, for stress testing and for identifying potential stress tests to run. That's about risk, not about prediction. So if you mean by prediction broadly implications of what if, then I am absolutely agreed. But I wanted to be clear that, at least from my point of view, finance, certainly finance as we do it in academia, does not turn on our ability to be able to estimate expected value or expected returns better than anybody else or anything. And, you know, so thank you for the question on that. One more?
I have to say up front that I did speak to you 38 years ago. So this is an unplanted question. This is fantastic stuff. Have you applied this to the current problems of the tapering of the quantitative easing, which is around the corner?
I wish we could or would have. We haven't at this moment because we're in the middle of this research. And even if we did, and we got something out of it, I don't think we would make it entirely public. We might tell you, or we might tell some people that it's interesting. The reason is we really have to be careful when you start to cross the line. I was showing you a technique here and a line of research. I was not literally saying that you should take this heat map and start to think about what you ought to be doing on quantitative easing. But to answer you in between, when we get the model done, we could certainly run simulations with that and try to estimate it. But that's complicated because, as everyone has pointed out, the feedbacks from other parts of macro, you know, someone was talking about, I think, reflexivity or something here. George Soros has used it sometimes, but that goes back to the sociologists, you know, self-fulfilling prophecy, feedbacks, right? Because of a prediction or an action, you get a reaction. And somebody announced it earlier this morning that they thought that sometimes regulators didn't recognize that when they do something or say they're going to do something, the system reacts to that and adjusts. We're very cognizant of that, and so we can look at that, but we're also recognize that some of these things are outside the realm of what we have built in this model. And so it would be, I just, the answer is yes, but it's a very tentative yes, because this is early. But someday, this kind of methodology geared up with other things could exactly answer that. And I will say that if those models that do that have the finance component of the uncertainty structure, the convexity, the potentially rapidly changing risk factors, they'll be much better models than the ones we see today or the ones that have tweaks to them of today. And if you look at Thailand in '97, those of you might remember, it's going along fine, right? And then we had a little real estate, and you say, how could a country, this government be doing just fine? And seemingly get to a point, I think the estimate was that 3/4 of the guarantees, if you could have held them, was something like 3/4 of the GDP of Thailand. I mean, it was just, how could something get there? Well, you now see it. It's not some strange, scary thing that we don't understand. It's scary, but we understand why. It's the double convexity, because the governments are guaranteeing banks. Banks are guaranteeing households, real estate, corporates. So they're doing a put on a put. That's double convexity. So if you go to the real sector assets that are changing, whether it's real estate or whatever, and ask how is that affecting the degree of liabilities of the government, that is extremely convex. It moves very fast, not in time, in space. So those kinds of things will come out, and I think they will be better. Thank you very much.